Very good morning to everyone. All my dear students, how are you all? Are we all good? Morning, everyone. Good morning, Nilay. Good morning, Mumta, Karthik, Nisha, Stephen. Okay, so we are into the live session for CA final. The topic that we have been doing right now is security valuation, in which we have completed one of the parts, which is the equity valuation. So we have covered till now how do we undertake the valuation of equity share, cash flows, amount of concept when it comes to equity valuation. Now it's time for us to take it to the other security, which is widely used as an investment purpose, and that is simply the bonds, or we can say debentures. So the bonds or debentures is what we are talking of as the valuation part. Now, valuation of the bonds is essentially going to be on the similar lines as what we have been doing for the equity shares also, because the basic principle, fundamental principle remains the same, which is simply taking the present value of future cash flows. But the future cash flows of a bond and equity shares are a bit different. And you know what? It's quite easier, or I cannot say it's easier, but it's more convenient to value a bond than equity share. First, because of some level of certainty with regards to the cash flows. In case of bonds, you receive some amount of interest from the bond, right? And so there we are, very sure that what are the cash flows that we are going to get from a bond. Second, calculating the rate of return that at which we are going to discount our cash flows can be also more easier as compared to equity shares, right? So the valuation part of the bonds or debentures, practically it is much more easier as compared to the equity shares, right? So if we talk of value of a bond, again the fundamental principle remains the same. Why do we really want to value the bond? Of course, because we want to take the decision with regards to whether we will buy it or not, whether we should invest in a bond or not. Of course, we are going to invest in a bond if the bond is available to us at a good price. When I say good price, it should be undervalued. So the concept remains the same. Value of bond is simply present value of future cash flows. Okay, present value of future cash flows. Now, value of a bond, we say it's present value of future cash flows. But can you tell me what sort of cash flows do we receive from a bond? What are the cash flows that we receive from a bond? Like in equity shares, we said we'll discount it using taking the present value of the coupons, so present value of the dividends. Then maybe after some years when we are going to sell it, we take the future value of that, right? Future value of the share, the expected future value of the shares. So same way in case of bond, what sort of cash flows do we get from a bond? What sort of cash flows do we get from a bond? Of course, we get some amount of interest on a regular interval, and also the final maturity value that we receive, right? So this is going to be present value of future interest receipts, right? So future interest receipts plus present value of future redemption value. Redemption amount. Okay, so that's the simple value of the bond. Now there are certain technical terms that we should be aware of when we want to value the bonds. let's certain terms called as, suppose for example, we say par value of a bond, or we also call it as face value of a bond, or we also call it as nominal value of a bond. Right? What do you mean by this par value, face value, or nominal value of a bond? What do we mean by that? Par value, face value, or nominal value of the bond. This is the value, value which is stated on the face of the bond. So this is the value which is stated on the face of the bond. But does that mean that this is always going to be the value of the bond? Does it mean that par value or face value, is it going to be always the value of the bond? No. It's like a face value or just a nominal value that is assigned to the bond, right? But of course, the value will keep on altering. Value will keep on altering with time and with the changing circumstances also. We'll observe, we'll just take into account of this at a later point of time. But yes, it's just the value which is stated on the bond. Now, the significance of this face value is more when we are supposed to calculate the future interest receipts. Okay, the significance over here is the future interest receipt which needs to be paid. That is going to be calculated on this face value or the nominal value. So the interest receipts that we are going to receive, we don't call it generally as an interest, right? Because interest can have different definitions also. So the interest which you receive on the face value of the bond is called as the coupon. And so there is always a coupon rate. So coupon rate is basically the rate of interest to be received on a bond. So rate of interest, coupon rate is basically the rate of interest to be received on a bond based on its par value. So rate of interest that you're going to receive on a bond, which is going to be based on par value, right? So whatever is the face value or the par value, the nominal value, a percentage of that will be paid to you as annual coupon. Okay. So suppose if your face value is 1,000 and the rate of interest which is stated in the bond, or the coupon rate which is stated in the bond, is, let's say, 12%. So what will be the amount of the interest that you're going to receive every year? It will be, of course, 12% of 1,000, which is 120 rupees. Okay, so coupon rate, then we say coupon rate, and this 1,000 is our par value. Then we say that 120 will be the coupon, 120 will be the amount of interest that you're going to receive, right? 120 will be the amount of interest that you're going to receive on this particular bond. Okay, everyone. Now, what if the bond says that coupon will be paid on a quarterly basis? If it is stated in the bond that coupon will be paid on a quarterly basis, can you tell me what will be the amount of every coupon which the bond is going to pay? What will be the amount of every coupon that the bond is going to pay? Suppose if it is stated that coupon is going to be paid quarterly. Coupon will be paid quarterly. So what do you think? What will be the amount of the coupon that you're going to receive? It's going to be 12% of 1,000, right? 12% of 1,000, which is 120, and you just divide it by 4. Right? So every quarter you're going to receive 30 as the coupon. So coupon frequency can be, annually, it can be quarterly, it can be half yearly, or it can be even in certain cases monthly also. So when we say frequency of coupon, this can be annually, half yearly, quarterly, and even monthly. Okay, so frequency of coupon payment can vary from annually, half yearly, quarterly, or monthly. Okay. Then we know something called as the maturity time period. The maturity time period is the amount of time after which the redemption value will happen, or redemption is going to happen. So maturity time period is the time period of redemption. Okay. Then we also say the redemption value. So redemption value is the final, or we can say bullet, or you can say one shot payment of principal. One shot payment of the principal, or you can say the principal may be redeemed at a par, or premium, or it may be even maybe redeemable discount, but generally we don't have that discount aspect. So redemption value is basically the final or the one shot payment that you're going to receive. Okay, so these are some of the basic terms in a bond that we should be aware of, right? The bond that we should be aware of. Now, of course, we are looking at the valuation of a bond from a market value perspective. When the bond is going to be valued in the market, there will be obviously demand and supply happening, and that demand and supply will play a role while determining the value of the bond, right? But when I want to suppose value a particular bond, when I'm going to value a particular bond, how do we go about valuing it? Let's try to do that, and then we will take it forward with other discussion also. So for example, let us say one of the bond is having a par value of 1,000. The coupon is, let's say, 10% per annum. So this is like payable. The coupon is payable on an annual basis. Maturity of the bond is suppose after 3 years. Okay. And redemption, suppose the redemption is going to happen at par, which is 1,000 itself. Now, what will be the cash flows from this bond? What will be the cash flows that I'm going to receive from this bond? Can you tell me what will be the cash flow in the first year? What's going to be the cash flow in the first year? What is the amount of cash flow in the first year, guys? Yeah. Cash flow in the first year, 100, correct? Because it's going to be 1,000 into 10%. And that same cash flow is going to be there even for subsequent years. So if you look at the year and the respective cash flows, so we say in year 1, they're going to receive a cash inflow of 100. Year 2, again 100. And in year 3, we get the redemption value plus the coupon. So it's going to be 1,100. Correct, guys? Yes. So these are the cash flows that we are going to receive from the bond, which is 100 for every year. And then the redemption value or the par value that we have, that is going to be redeemed at the end. It's going to be redeemed at the end. Okay. So now when we are looking at this redemption and the cash flows, I want to value this bond, guys. How do I value this bond? We have to take the present value of it, right? I'll have to take the present value of the cash flows. Now, when I want to take the present value of cash flows, I need a rate. I need a rate at which I'm going to discount the cash flows. I'll need a rate at which I'm going to discount the cash flows. So what will be that rate? Can I discount these cash flows at the same coupon rate as 10%? Can I discount the cash flows at same 10% as coupon rate? Yes. No, right? We cannot discount it because coupon rate is just the rate of interest which the bond has promised us as a percentage of the par value. Now, generally, we discount our cash flows using what rate of return base. So, whenever I want to value any asset, at what rate are we going to discount the cash flows? At what rate are we going to discount the cash flows? We always discount the cash flows at our required rate of return. We always discount the cash flows at our required rate of return. So this is going to be present value of future cash flows discounted using required rate of return. Using required rate of return. So present value of future cash flows discounted using required rate of return. Now, tell me guys, if it is to be discounted at required rate of return, our required rate of return, are we going to have the same required rate of return for all the types of debentures? Do we need the same return for all debentures? Like for example, if it's a government security and if it's a corporate debenture, if it's a government security or if it's a corporate debenture, do we have the same required rate of return from the debenture? We have the same required rate of return from the debenture. Yes or no, guys? No, we'll have obviously a higher rate of return for the corporate debentures. Correct, guys? We'll have a higher rate of return for the corporate debentures because of the risk involved. So over here also, we follow the same fundamental principle. That is, higher the rate of return, higher the risk, higher the return that we require. Right? So that required rate of return, the rate of return which we want, required rate of return, in the bond language, it is said to be yield to maturity. In the bond language, it is said to be yield to maturity. So required rate of return is what we call it as yield to maturity. Now, how do we determine what is the required rate of return? Over here also, there are multiple models based on the default chance. Like, have you heard something called as credit rating of a bonds? Have you heard something called as credit rating of bonds? Have you heard of it? Like AAA rating, AA rating, right? Double B rating, right? So whenever we have this sort of rating of a bond, it is quite obvious the bond with highest rating. What do you understand with that? Like suppose if we have a AAA rating and there is a AA rating, which of these two bonds is more risky? Of course, AA rating. What sort of risk do you perceive in a bond? What sort of risk do you really perceive in a bond? Because the company has stated that there is a rate of return or a fixed rate of return, like in this case, 10% risk, 10% is the coupon or the interest that will be paid. What sort of risk are we really looking at when it comes to bond? First, we are looking at the default risk. What are the chances that a particular bond may default on its payment? Right? It is possible that the bond may not be able to give you the redemption value, or it's possible that bond may not be able to give you the promised coupons also in some cases. So when you have such default, wherever the chance of that default is high, it will obviously get a lower credit rating. Whenever there are chances of high default, the credit rating will be lower. Okay. Now, not only that, when we are looking at default, the credit rating also depends on the security level also. Like if you have a bond which is a secured and if you have a bond which is unsecured. Now it is quite obvious which bond is expected to have a higher rating, a bond with a higher level, which is secured or which is unsecured. Which bond do you expect to have a higher rating? Of course, a secured bond, right? Of course, a secured one. Now, even in secured, if you have something like fixed, or you can say uh, fixed charge and floating charge, where do you find that the rating will be higher? Fixed charge or floating charge? Where do you expect the bond value, I mean, the rating to be higher, for a fixed charge or a floating charge? Of course, for a fixed charge, because you know what specific, right? Because when you have a fixed charge, you have the direct claim over that asset, and even after payment of that, even after recovery of the assets from the recovery of the money from that fixed charge, you go to the other floating charge also. So that is where you are actually trying to define the various risks that we have in a bond, and based on that risk, can I say your required return? Based on that risk, can I say your required return will also vary, right? So of course, credit rating, Karthik, you're right. Credit rating is based on how secure the bond or debenture is, or not only that, but it also depends on the chances of default. It's quite possible that one of the bond which is secured may be having a lower rating as compared to another company bond which is having an unsecured bond, because there the chances of default, I cannot say it is based on the secured or unsecured, but the idea is what are the chances that the bond investor will lose the money. If there are high chances of the bond investor losing the money, then you will find that there are rating that is happening to the company will be, or the bond will be lower. So chance of default is what we are looking at. Not only that, chance of default, but there is another advanced concept that we have, but we're not going to cover it right now, which is loss at default. Like for example, suppose the company goes for a default, right? Does that mean that you're not going to get anything? No. We want to see, suppose the company defaults, then what is the amount of loss that I will have? If suppose the loss is 30%, so I'll be able to realize, let's say, 70% of the invested money, right? So it depends on two aspects. One is what is the level of security, or what is the chance of default, and second is what is the loss when the default happens, right? So the whole idea of this discussion is, when the bonds are having different varying degrees of risk, the rate of return on each bond is also going to be different. Like if one company has a secured debenture and the same company is also having unsecured debenture, will you require the same rate of return for both the debentures? Yeah, tell me guys. Will you require the same rate of return for both the debentures? One is a secured debenture, another is an unsecured debenture. No. Now, even in case of, let's say, secured debentures, if one bond is having a AAA rating, other bond is having a AA rating, will your required return be same for both types of bonds? No, because the risk is different. So as the risk is different, the return that we require will be also different. And therefore, that required rate of return is what we call as the yield to maturity, the yield that we as an investor require, or the yield that we are expecting to earn from a company, earn from the debenture of a company when we invest in that debenture and try to collect the money and try to redeem the money after a certain number of years. That's the rate of return which we are looking for. My required rate of return depends on the risk that is involved in the debenture or the bond. Is this concept of yield to maturity, the required rate of return from a bond, very clear, everyone? Yes. So are we under an assumption that required rate of return or yield to maturity is going to be constant for all the bonds? No, it will keep on differing. Achha. And do you expect this YTM to be a constant number for all the 3 years? Do you expect the YTM, or the required rate of return, to be remaining same? Like if I buy the bond today, or I go for buying the bond 1 year later, or I go for buying the bond 2 years later, is my YTM going to be a constant number? Is the YTM going to be a constant number? No, YTM will keep on changing as the market is changing. Like for example, if I tell you that current repo rate, what's the current repo rate of RBI? What's the current repo rate of RBI, guys? What's the current repo rate of RBI? I'm just testing your general knowledge. Tell me, what's the current repo rate of RBI? Repo rate, the rate at which banks borrow from RBI. What's the repo rate? It's 6.5%, right? Perfect. So now when the repo rate, when the risk-free rate is 6.5%, you find that government securities are also providing you similar yield, similar rate of return. You want the YTM of a bond. Will you expect the YTM of the bond to be same risk-free 6.5%? Will you expect the YTM of a bond to be same risk-free 6.5%? Tell me, guys. Do you expect the YTM of the bond to be same 6.5% or a higher than that? Yeah, of course, higher than that, right? So let's say when the bond was issued, at that time, YTM, was 6.5% since the bond was rated something. Based on that, you assigned the risk premium to that. And suppose it is 8%. Now, when you go to, this is happening in, suppose year 0. Now, few months back, let's say year 0.5, means let's say 6 months later, the repo rate of RBI has changed. So suppose the repo rate of RBI changed to 6.75%. So with the perception that ongoing risk-free rate in the market is 6.75%, will you still be requiring a return of 8% if you want to invest in this bond? Will you require the same 8%? No, of course, I'll be requiring a higher return because risk-free rate has increased. The risk-free rate has increased from 6.5 to 6.75. So, of course, my rate of return, the return which I want, that will also increase. Okay. So, YTM of a bond will change due to changes in the risk-free rate. Am I right? Is this point clear, everyone? YTM of a bond will increase due to changes in the risk-free rate. Yes or no, guys? Right? As the risk-free rate changes, our required rate from the bond is also going to increase because my opportunity cost of capital is changing. Right? So, of course, this may become, maybe 8.25%. Now, what if I tell you, suppose in year 1, repo is same 6.75, but now an event has happened with the company due to which the rating of the company, which was for rating of the debenture, which was initially AAA, now it has reduced to AA. Your repo is same, basically risk-free rate is same, but now the rating has reduced. So do you expect the YTM to be remaining same even after another 6 months? Will you expect the YTM or will you require the same rate of return even after 1 month, even after 1 year? No, the rate of return will change because the investor who is going to buy the bond in year 1 will have a different rate of return as compared to the investor who bought it in year half. Right? So maybe even if the risk-free rate is same, because of the fall in the rating of the bond, you may ask for additional rate of return, which would be 8.5%. Right? So the YTM is not a sacrosanct number. Just put it in your mind. It's not a sacrosanct number. It's not something which is going to remain constant. It will continuously keep on changing due to changes in the risk-free rate, due to changes in the credit rating of the bond, due to macroeconomic events that are happening. So that is subject to a lot of change that's going to happen. Okay. Anyways, so now required rate of return is basically your YTM. So when I want to calculate the value of a bond, it is quite obvious that value of the bond will be determined as the present value of the future cash flows. Now, future cash flows are nothing but future coupons and the redemption values, right? And let's say YTM of a bond is currently 12%. Considering the risk that we have in the bond, considering the risk-free rate that's ongoing in the bond, let us assume that it's 12% is the required rate of return. Can we get the value of this bond now? Can we get the value of this bond, guys? Yes. So we have to simply take the present value factor at the rate of YTM. A present value factor at the rate of YTM will be 1 divided by 1.12, right? So 1 divided by 1.12 to the power of number of years, right? And when I do this for the other years, I simply take the present value factor, and then present value factor, we multiply it with the YTM. So cash flow multiplied by the present value factor, we take a total, and we arrive at like this number. Okay, so present value or value of the bond is standing at 951.96. Present value of the bond is 951.96. Okay, did we get it? At 12%, it should be 951.96. You know what? Instead of writing each cash flow like this, I can actually do it in a bit more better way also. I need not write lot many numbers. Can I simply say it like this? Here, cash flows, present value factor, and then PV. Here, 1, 2, 3. I can say it is 100. And what present value factor am I going to have over here? We are going to have the present value annuity factor. I hope you are aware how to calculate the annuity factor. You know how to calculate the annuity factor, right, guys? Correct. So let's say present value factor at 12%, annuity factor, and then we just write the year 3 cash flow. Year 3 cash flow, which is 1000. So what's the present value annuity factor at 12%, guys? Tell me. Give me the present value annuity factor. The present value annuity factor. So that's 2.4018, right? And for the third year, the present value factor is anyways, we have already calculated it. And then we can calculate the present value to be cash flow multiplied by the PV factor, and then take a sum of it. You can get the same value of the bond. Correct, guys? So whatever be the tenure of the bond, you can simply use this annuity factor to get it. If you're following this method, it will take a lot of lines there. Like if it's a 7 years or 8 year bond, you'll have to write down lot many values. Instead of that, when we want to obtain the value of a bond, we can simply calculate it by this way. You can simply take the year, the cash flows, take the present value factors, and then multiply it with the cash flows to get the P. Okay. Now, let me just do one thing, an example to you, just for your practice. Suppose the par value is 1000, coupon rate is 8%, maturity is suppose 5 years, redemption is let's say 1050, and YTM is suppose 11%. Can you give me the value of the bond? Can you calculate the value of this bond, guys? Current value of the bond. Can you calculate it? Yes. Give me the value of this bond, guys. Par value 1000, coupon is 8%, maturity is 5 years, and this is going to be redeemed at 1050. So what's the and with a YTM of 11%, what should be the value of this bond? Please calculate and give it to me, guys. Come on, just to practice for you. Yep. Give me the value. Every year it's going to be 80 inflow. And then in the 5th year, you will have an inflow of 1050. Just apply the PV factor and then give me the value of the bond. Give me the value of the bond, please. Yes, give me the value of the bond. First, what's the present value factor that you're using for year 1 to 5? Present value factor for year 1 to 5. No, it's 11%, I know. But what's the factor? Okay, that's 3.695. Okay. So present value will be this, multiply this, and 3.696. 1 divided by 1.11, power of number of years. And the fifth year PV factor will be 0.593. Present value factor into cash flows. And then when we take a summation, we arrive at a value of 918.72. Correct? I don't know whether this present value factor is correct or not. Let me just get the PV factor. Rate is 11%. Anchor is, number of years is 5. $3.696, yeah. 3.696, and this is 0.593. Yeah, so somewhere around we'll be getting the value as 918. So it may be somewhat different. Answer may be quite different because of the decimal part. But anyways, if you take the PV factor as 3 decimals or 4 decimals, somewhere rounding up error is possible. So we get approximate answer is 918, right? 918 point something is the value that we are getting, the value of the bond. Correct, guys? I will getting the value of this bond as 918.80. Yes. Okay. Now, with this same bond, let's try to understand an important thing. With this same bond, suppose instead of 11%, the YTM is suppose 14%. Can we get the value of the bond on a similar lines? Everything is remaining same, just the YTM of the bond is, let's say, 14%. Get me the value of the bond at a YTM of 14% less. Get me the YTM of the bond. Get me the value of the bond. Sorry, at a YTM of 14%. Give me the value of the bond. Yeah, value of the bond when the YTM is 14%. Okay, 819.6. Okay, so let me just replicate this. So year 1 to 5, you have a cash flows. Cash flows are going to remain same. The PV factor is going to change because now the rate of return is 14%. So we take 3.433 as the PV annuity factor, and even this is going to be like 14. So is the value 819.98? 819 is the value of the bond, everyone. Okay, look at these two cases. Look at these two cases and tell me, what do you feel about the relationship between the YTM and the bond value? Looking at these two cases, can you tell me what sort of relation do you think, or do you get between the YTM and the bond value? Yeah. So can I say there's an inverse relation? There's an inverse relation, right, guys? There's an inverse relation between the value of the bond and the YTM. So we can definitely say here, as the YTM increases, bond value decreases. So as the YTM increases, the bond value is going to decrease. Correct, guys? As the YTM is increasing, bond value is going to decrease, and that's the inverse relation between the YTM and the bond value. Okay, so just keep that point in mind. We'll recall it after some time. Okay, press the memory plus button in your mind, M plus button. We'll press the MRC button at a later point of time. Okay, I'll ask you to recall the MRC, then you should remind me this, that we have already learned, sir. YTM, when the YTM increases, the bond value is going to decrease. Okay. Now, when we have the numbers and when we have the value of the bond, how do we go about calculating the YTM of the bonds? That's what we are going to learn over here. So suppose we have a bond with certain parameters. So let's say par value of the bond is 1,000. Coupon that you are receiving is 9%. Maturity of the bond is suppose 6 years. Redemption of the bond is, let's say, 1,100 at a premium. We don't have the YTM, but what we have is the price of the bond. So current price of the bond is, let's say, 960. Current price of the bond is suppose 960, and I want the value of YTM. And I want the value of YTM. So how do we go about computing the YTM, guys? I know the par value, the coupon, the maturity, redemption, and the price of the bond. I want to know what is the required rate of return for the investor. So how do we go about calculating this YTM? Anyone? Can I think of any idea? Sir, how do we find out the rate of return from this bond, the required rate of return from this bond, if the price is known as 960? Yeah. Can I say we'll try to assume one particular YTM and try to calculate the value of the bond, right? So we can do definitely the same way as we have been doing with the IRR, correct? Okay. So let's try to solve it. We'll say let YTM be certain number, right? So we'll write down here cash flows, here cash flows, then we have the PV factor, and then the PV. So let me assume the YTM initially to be, let's say, 10%. So at a YTM assumption of 10%, and when we write down the number of years as 1, 2, 3, not you know, we'll say year 1 to 6, and then we have year 6 finally. Yeah. So from year 1 to 6, we can have the cash flows to be 90 every year. And in the final year, we have 1100 as the cash flow. What's the present value factor at 10%, guys? Annuity factor rather. What's the annuity factor for 10%? Annuity factor for 10%, guys. Give me the annuity factor for 10%. How much is it? 4.355. Okay. 4.355. Okay. So, and what's the final annuity factor? I mean, not annuity factor, final PV factor for the year 6. What's the PV factor for year 6? PV factor for year 6, 0.564. Correct? So let's get the present value of the bond, which is cash flow into PV factor. Correct? And then take a sum of it. We find the bond value to be 1012.35. But we want to have the bond value to be 960. So is our assumption of 10% being the YTM correct or incorrect? No, that's not correct. So we'll have to take a different rate now to calculate the YTM. Right, guys? So the new rate, should it be higher than 10% or lower than 10%? The new rate that we are going to look for, is it going to be higher than 10% or less than 10%? Of course, higher than 10%, right? Because when the value has to be reduced, I have to reduce it from 1012 to 960. The value needs to be reduced. If the value is supposed to be reduced, then I'll have to use a higher rate. So let me just try it out, this same thing with, let's say, 11%, guys. So at 11%, tell me what's the PV factor, present value annuity factor at 11%. What's the present value annuity factor at 11%, guys? Yeah, how much? 4.231. And 6th year factor for 6th year, present value factor for 6th year, 0.535. Correct? Okay, so we take the PV as cash flow multiplied by present value factor, and then I apply the summation. Oh, it's 969. So what should we do? We haven't reached 960. So what should be the other part now? Should we raise this rate of interest again, right? From 11%, I'll have to increase it to 12%. So at 12%, what's the present value annuity factor, guys? Present value annuity factor at 12%. 4.111. And the factor for 6th year, present value factor for 6th year, 0.507. Okay. So present value will be present value factor multiplied by the cash flows. And then we take the sum of it, which is 927.69. Can I say we have gone beyond that now? So we have like the cash flows available along with that, we have computed the present value. So present value is one is 960, another is 927. So it is like the way we compute the values. So at 11%, we have the bond value to be 969.29. And then at 12%, the value is 927.69. So at 11%, we have 969.29. At 12%, we have 927.69. But what is the value of the bond that we want? We want the value of the bond to be 960. So what should be that rate at which the value of the bond will equal to 960? Yep. Can you calculate that IRR? Can you calculate the YTM? Right? We are expert in this now because we have done it throughout our CA Inter. We have done also at final level also. So can you give me what's the IRR here? What's the IRR or the YTM of the bond here? So between 11 to 12%, what is that YTM? So the way we do is simply write down the YTM and the value of the bond. So when it was 11%, the value was 969.29. And when it is 12%, the value was 927.69. So here, there has been some change. So change in YTM was, YTM increased by 1%. Then the value has changed by 41.6 rupees. But what is the change that we wanted? What is the change that we wanted? Yeah. What's the change that we wanted? Did we want the bond value to be reduced by 41.6? No. What is the change that we wanted? Required change in the value. Required change in the value is like we wanted to reduce it from 969.29 to 960. So we wanted to reduce it by minus, or I can say 960 minus this. We wanted to change it by just 9.29, right? Because we wanted to bring it from 969 to 960. So the change that we wanted over here was only of minus 9.29. So for this required change, what's the change that we should have in the YTM? Do the simple cross multiplication. So that's 9.29 into 1 divided by this. So that is percentage wise, it is 0.22%. So what's the YTM of the bond? YTM of the bond will be 11% plus 0.22%. 11% plus 0.22%. So YTM is 11% plus 0.22%, which is 11.22%. Right? 11.2223, somewhere approximate number. That's okay. So YTM is 11.22 or 23%. That's the YTM of the bond. So are we clear, guys, how to get the YTM of the bond when we, when we have the price of the bond? Correct, guys? Are we clear how to get the YTM of the bond when we have the price of the bond? Yes, everyone? Yes, okay. Now, simple, just like we have been doing the YTM, IRR, that's the same method which we are using over here. Okay. Now, it may happen that the cash flows of the bond are paid to you on a semi-annual basis. Right? It's quite possible that the cash flow will be paid to you on a semi-annual basis. So how do we go about valuing such bonds? So suppose par value of a bond is, let's say, 100. Coupon is stated to be, suppose, 7%. Maturity is 108. Sorry, maturity is suppose after 5 years. Okay, redemption is 108, and YTM that's ongoing is, let's say, 6% in the market. Now, when the coupon is like 7%, this is 7% per annum, but this is payable half yearly. So par value is 100, coupon rate is 7%, that's a 7% per annum rate, but then that coupon is payable to us on a half yearly basis. Coupon is payable to us on a half yearly basis. So, and the maturity is, of course, 5 years. So, redemption 108 when the YTM is 6%. Of course, this is 6% per annum. How do we get the value of this bond now? How do we get the YTM? Sorry, how do we get the value of this bond? So, value of this bond will be again calculated on the same way by taking the present value of future cash flows. But here we will not say the number of years, but we will say the number of half years. What will be the number of half years, guys, in this case? How many half years do I need to count? Because there are 5 years to the bond. The number of half years will be, of course, 10. So it will be like 1 to 10. And then in the 10th half year, we are going to get the redemption. Right? So what's the cash flows? 1 to 10. What will be the cash flow? 1 to 10. What will be the cash flow, guys? Every half year, what will be the amount of cash flow? 3.5. Perfect. And in the final year, you have 108. Now, when I want to get the present value of it, this is going to be a present value factor at what rate, guys? Present value factor will be calculated at what rate of return? Can I discount it using 6%? Can I discount it using 6%? No, I'll have to discount it, of course, half of it, which is 3%. I'll have to discount it at a half, which is 3%. So present value factor at 3%. So give me the annuity factor. Give me the annuity factor for present value factor at 3%, guys. Give me the annuity factor at 3%. And also the term value. Yes. How much is it? 4 point. What's the annuity factor? 4.580. No. 3% for 10 years doesn't seem to be 4.580. We will take the rate as 3%. And per number of years is 8.53. It should be 8.530. And what's the term? 10th year PV factor 0.744. 10th year PV factor 0.744. 1 divided by 1.03 power of 10. 0.744. Now we take the PV as simply cash flow multiplied by the PV factor, and then we take a summation of it. So the value of the bond will be 110.22. So are we clear, guys? If it is half yearly cash flows, how do we get the value of it? Yes, half yearly coupons. So if it's half yearly coupon, you just need to divide the coupon rate by 2 and also the YTM rate by 2 to arrive at the present value of the bond. Is it clear, everyone? Yes, got it? Sure, great. Now, let me just bring up some questions for practice to you. Take up the assignment. YTM is the investor's point of view, right? Yes, yes, Vignesh. It's from the investor's point of view, what's the required rate of return? Because once the bond is out in the market, it will trade according to the required return of the investor. Then in half yearly, PV will increase from par value. Is it? No, no, no. It's not necessary. It's not necessary that PV will increase at, it will become, the bond value will trade at a premium. It's nothing like that. It's because of the YTM. So YTM is lower, and therefore we find this is to be, trading at a premium. Okay. So one thing that we can definitely vouch for. The sheets are like shifted. Now suppose let us consider a very clean case where there is no redemption premium or discount, and if we say that par value of the bond is 1,000, okay, and if we take the suppose the number of years or the maturity to be, let's say, 3 years, coupon rate is assuming it to be 10%, and let us say the redemption, okay, redemption is at par. So redemption is also, let's say, it is 1,000. So the redemption is 1,000, and I want to see what is the value of the bond at different YTM. So let me just do one thing, write down the year, the cash flows, PV factor, and then the PV. So suppose year 1, 2, 3, we have one set of cash flow, and then year 3, we have the terminal value cash flow. So cash flows that we observe, if from year 1 to 3, it is going to be 100, and final year it is 1,000. Now suppose I want to discount it, the present value factor, let's say I want to take it at 8%. Give me the present value annuity factor at 8%, guys. Give me the present value annuity factor at 8%. 2.577, and then the present value factor at 8%. What's the present value factor? 0.794. So if we take a PV and calculate the present value of it, this is 1051.7. Okay. Now suppose we take the present value factor, we take the YTM to be suppose 10%. And then when we calculate the present value, let us see what's the number. Give me the PV factor, annuity factor at 10%, and also the term and present value factor after 3 years. This is 2.487. It is 10%. 2.49. 2.487, and this is like 1 divided by 1.1 power of 3. So PV will be present value factor into cash flows. Okay, and then we take a sum of it. Can we say we are getting the value as 1000? And then same thing, if I do it for, let's say, present value factor, I want to calculate at a YTM of suppose 11%. So this is like just verify if you're getting these PV factors at 11%. So we get the PV $975.56. Now look at the YTMs of 8, 10, and 11, and look at the price. Can you give me some sort of conclusion or some sort of your insights? Any insight that you can think of? So to summarize, I can say YTM and the value of the bond. When the YTM was 8%, value of the bond was 1051. When the YTM was 10%, then the value of the bond was 1000. And when the YTM was taken to 11%, the YTM was 975.56. Can you think of something like this? Can you think of some insights or some analysis from this? We know as the YTM increases, the bond decreases. That is what already we have covered. I'm not asking you to do MRC right now. Look at these numbers and just have a look at the coupon rate also. Coupon rate is, of course, constantly 10%. Coupon rate is, let's say, constantly 10%. What conclusion can you really draw from this thing? Anyone? What conclusion can you draw from this? Compare the coupon, YTM, and the value. Yes. Perfect. Absolutely correct, Karthik. When your YTM is less than the coupon rate, the bond trades at premium, right? And when your YTM is equal to the coupon rate, the bond trades at par. And when YTM is greater than coupon, then the bond will trade at discount. Got it? Are we able to understand this? It's pretty simple, right? Coupon rate, if it is going to be more than what the investor requires, the bond will be definitely trading at a premium. If the coupon rate is 10%, right, and the YTM is 8%, so of course, when the coupon is higher, the bond is giving you more return than what you require. So of course, the bond is going to be attractive and it's going to be lucrative for all the investors, and therefore it will be trading at a premium. But whereas if the coupon is same as the YTM, then the bond is going to trade at par. Okay, and when it is going to trade at when the coupon and YTM are like other direction, where your YTM is more, basically you require more return from the bond than what it is promising you, then the bond has to trade at a discount. Is this clear, everyone? Yeah. Okay. Then let's go for some questions from the assignment. Let us say question number 18, guys. Question number 18. Yeah. Nominal value of 10% bonds issued by the company is 100. The bonds are redeemable at 110 at the end of year 5. Determine the value of the bond if the required yield is 5%, 5.1%, 10%, and 10.1%. So nominal value of the bond with a coupon rate of 10%. No, it is rupees 100. The bonds are redeemable at 110 at the end of year 5. You have to determine the value of the bond if the required yield is 5, 5.1, 10, or 10.1. So there are 4 different values that we have to get. So for this question 18, we've got the parameters as face value of the bond to be 100, coupon is 10%, redemption second, let me open it again. Yeah. So redemption is 110 because it's 110 at the end of 5 years. So maturity is 5 years. Okay. And of course, this is 10% per annum. Now we have a range of YTM at which we want to compute the value of the bond. Okay. So let us say the year cash flows, and then we take down the values at multiple YTMs. So we need to take the present value factor and the present value factor, and obviously we need to get the present value of the cash flows. Okay. So we have been given in the question that we have to take a YTM of 5%, 5.1, 10%, 10.1%. Okay. So YTM of 5%. Next will be YTM of 5.1%. Then it is going to be YTM of 10%. And of course, YTM of 10.1%. Okay. Now, we'll write down the present value factor and then the present value. Okay. So as far as years are concerned, we have got 5 years. So year 1 to 5 and then year 5. Okay. What are the cash flows that we are going to get? From year 1 to 5, every year we are going to get cash flow of 10. Okay. And then year 5, we have got a redemption of 110. So for each of these levels, for each of these values of YTM, we will need the present value factor and the present value. Okay. So give me the present value annuity factor is first at 5%. What is the present value annuity factor for 5%? Present value annuity factor for 5%. That's 4.33. 4.329. Okay. Then what's the PV factor for 5th year? 0.784. So PV will be simply cash flow multiplied by the PV factor. And then we take a total of it. So value of the bond is of course 129.53. Value of the bond is 129.53. Did you all get it? Same way, give me the value of the bond at 5.1, 10% and 10.1 years. Solve it fully and give me the final answers. .1. This comes out to be 128.98. Please verify it, guys. Is it 128.98? Everyone, just check. Let's check if it is 128.98. Everyone. Correct. Okay. Give me the rate for, value for 10 and 10.1% also. At 10% it is 106.21. Are we getting 106.21 at 10%? No, very different. Okay, 10 it is 106.21. Okay. And then at 10.1%, check if it is 105.80 or 79, whatever. Please check if you're getting these answers by using the same technique. Just need to write down the PV factors, multiply it with PV so that you get multiply it with the cash flow. Sorry, PV factor multiply by cash flow. That should give you the value of the bond at different YTMs. Yes, got it? Okay, fine. Then let's try out this question number 19, guys. An investor is considering purchasing the following bond with a face value of 100, coupon rate of 11%, maturity 3 years. If he wants a yield of 13%, what's the maximum price he should be ready to pay? And if the bond is selling at 97.6, what would be his yield? Can we solve this? Is it solvable by you? Does it seem to be solvable? Yes. Sure. Try it out, guys. Get the maximum price. Give me the maximum price that can be paid. So in this question number 19, we have the face value to be 100. Coupon rate is 11%. Maturity is 3 years. And redemption, of course, we'll take it as 100 only because it hasn't been specified regarding the premium. So if we take the YTM of 11%, we take the YTM of 11% and apply the PV factors to this. 1 to 3, you're going to have 10 rupee cash flow. Get the PV factor. Then third year, we're going to get 100 cash flow. Get the PV factor. Take the total of PVs. Yes, coupon is 11, redemption value 100, the present value factor at 11%. What is the YTM? Okay, YTM is 13%. Okay. So at YTM of 13%, what's the present value factor? 2.44. Is it? And the present value for just verify, guys. 2.361. 2.361. 95.28. Value of the bond is it 95.28? You get it? Yes. Okay, so 95.28, that's the value. Then the second thing is, if the bond is selling at 97.6, what would be his yield? Like suppose at a YTM of 13%, it is 95.28. And if you want the price to be 97.6, so you want to increase the YTM. What should I do with this, the YTM of 13%? What should I do with this 13% YTM? Should I increase it or decrease it? We'll have to increase it, right? So let us try to increase it. Suppose YTM of 14%. We can get the PV factors. Yeah. The PV factors is What's the annuity factor at 14%? 2.322. And what's the PV factor for this? 0.675. This will be PV factor multiplied by cash flow. So this comes out to 93.06. And we want the value to be 97.6. We want the value of the bond to be 97.6. You can simply carry out the interpolation here. The same method that we use for calculating the IRR. So at 13%, the price is, what is the value that we want? 1 second. Okay, 97.6 is the value that we want. 97.6. So there will be a change. There will be a change. We want it to be 97.6. So currently we are valued at what? 95.28. So we need to increase it, guys. So present value factor needs to be taken at maybe 12%. So at 12%, give me the PV factor, guys, because we want it to be increasing to 97.6. Currently at 13%, it is 95.28. So I'll have to increase the price. When I have to increase the price, I need to reduce the YTM. So this is 2.402. And then what's the PV factor for third year at 12%? 0.712. 97.62. Okay. So somewhere we can say approximately 12% is the YTM, right? Because we need not do the YTM interpolation also because it's very close. 97.60 and 97.62. It's very close. So almost we are getting the same number. It's approximately the YTM stands at 12%. Okay. Did we get this? Approximately YTM. You can say it is YTM is 12%. If you want to calculate it exactly, you can simply do some sort of interpolation and get the answer for it. Okay. Are we good, guys? Sure. Let's go for another question. Question number 20, guys. Let's look at question 20. Calculate the market price of a 10% Government of India security currently quoted at 110, but the yield is expected to go up by 1%. So Government of India, 10% Government of India security currently quoted at 110, but the yield is expected to go up by 1%. So currently it is trading at 110. I need to get here, it's a bit different question. There's no, what you say, redemption time period given to us. Maturity period is not given to us. And they're stating that currently it is trading at 110. So I cannot say something called as YTM over here, but yes, I can say what is my current yield in this bond. Current yield is basically what's the rate of return that you're expecting from the that you're likely to get from the bond, taking into account the current price and the yield. Current yield is simple method of calculating the rate of return. Now, of course, current yield is simply going to be the interest upon rupees is the interest on a value of investment. Today you need to invest 110. So on an investment of 110, you're going to earn 10 rupee. So current yield is basically 10 divided by 110, which is 9.09%. right? Now they're saying yield is expected to go up by 1%. If the yield is going to increase by 1%, what will be the revised yield? Can you tell me what will be the revised yield? The yield is expected to go up by 1%. So currently the yield of the bond is like 9.09% because you are going to buy the bond at 110, and on that you are going to receive an interest of 10 rupees. So revised yield will be this 9.09% plus 1%. So the revised yield will be 9.09% plus 1%, which is 10.09% is the revised yield. So what will be the price? Price of the bond. What will be the new price of the bond? Price of the bond will be, of course, like when it is current yield equal to interest upon price. So price will be obviously interest upon current yield. So price will be like interest of 10 divided by current yield of 10.09%. So the now new price is going to be 99.09. 99.10. Yes. 99.10, 99.11, whatever it is. Now, this second question is very easy. Second question is very easy, guys. Can you quickly give me the answer of second question? Second part of question 20. That's really very easy. Yeah. 7.5% coupon, face value of 10,000. Term to maturity is 2 years. Maturity period is 2 years. Presently, it is yielding you 6%. What is the interest pay? Interest is payable half yearly. Can you calculate the value quickly? So the face value is 10,000. Coupon rate is 7.5%. Since the coupon is 7.5%, but then even if the coupon is 7.5%, term to maturity is 2 years, interest is payable half yearly. This is of course percent per annum. Payable half yearly. Redemption is 100. Maturity is 2 years. Redemption is 100. Maturity is 2 years. Presently, it is yielding 6%. So the YTM is 6%. 6%, this is per annum, but I cannot use this rate. I'll have to use the 3% number because it is per semi-annual. I can say per half year. So based on this, we'll write down, of course, the year and the cash flow. So here it is like 1 to 4. It's not going to be year, rather it's going to be half year. So for half year 1 to 4, what is the cash flow that we are expecting? What is the cash flow every half year, guys? Every half year, what will be the cash flow? Can I say 10,000 multiplied by 7.5% multiplied by 0.5 or half, which is 375. And then in the fourth year, cash flow is going to be the par value of the bond, or the fourth half year. Par value will be realized, which is 10,000. Just need to take the present value factor at 3%. And then take the PV and simply take the summation. Yeah, what's the PV factor? 3.717. And what about the fourth, the terminal PV factor? Okay, 0.888. So total is 10,273. Okay, 10,273 is the value of the bond. Correct, guys? Are we getting this? Are you able to get this value? Okay, fine. Let's do question number 21 now, which is about the convertible debentures or convertible bonds. A convertible bond. I hope you know what is a convertible bond. What do you mean by convertible bond, guys? What do you understand by convertible bond? Yep. So basically, if you're an investor in a convertible bond, you have the power or you have a right to get it converted to equity shares. You have a choice. It's not a mandate unless and until the bond is like compulsorily convertible. So whenever it is compulsorily convertible, it automatically gets converted to equity. But when we have just convertible bond, so you basically have got an option. So as an investor, you have got an option to get it converted to equity shares on maturity. So on the date of maturity, you have a choice to get it converted to equity shares or realize the cash value of it. So convertible bond with a face value of 1,000 is issued at 1350 with coupon rate of 10.5%. Conversion rate is 14 shares per bond. Current market price of the bond and the share is 1475 and 80. What is the premium over the conversion value? Okay. Now, what is a premium over conversion value? So the bond is going to get converted to 14 shares. You have a choice to get it converted to 14 shares. So here, and we look at question 21. Yeah. Conversion rate is given to us. Conversion rate is like 14 shares. Conversion rate is 14 shares per bond. So conversion rate is 14 shares per bond. So each bond is going to get converted to 14 shares. Okay. Now, current market price of the bond is 1475 and premium over conversion value is what we are going to compute. Current market price of the shares is also 80. So market price of share is 80, right? Market price of the share is 80. So what is the conversion value? So suppose these bonds are getting converted to equity shares. What is the conversion value? What is the conversion value? So if this bond is getting converted to equity shares, what is the conversion value? So we have got like 14 shares multiplied by each share, 14 shares per bond. So each of the share is valued at 80. So of course, conversion value stands as 1120. But what's the market price of bond? Market price of bond is given as 1475. Market price of the bond is given as 1475, which is 1475. So do you see a premium attached to it? Do you see a premium attached to it? Is there a premium that is being attached? So when the bond was issued, it was issued at 1350. Current price of the bond is 1475. And if you get it converted to equity shares today, Of course, you don't have the right to get it converted to equity shares today, but if you want to get it converted to equity shares today, it is worth 1120. But there is a premium. I mean, the market price of the bond is above the conversion value. Market price of the bond is above the conversion value. So are people ready to pay premium for this type of bond over and above their conversion value? Yes or no? Are people paying premium? Yes. So what is the conversion that we have? What is the premium over conversion value? Premium over conversion value. Can I say it is 1475 over and above the conversion value? So in rupee terms, it is 1475 minus 1120, 355. So what is the premium percentage over conversion value? Which is 355. Of course, it is 355 divided by 1120 multiplied by 100, which is 355 divided by 1120 multiplied by 100. So that's like 31.69%. 31.69 or 31.70%. Okay, this is the calculation, that is what we have done. But my question to you is, why are people ready to pay this premium of 355 for this bond? Why are people ready to pay a premium of 31.7% or in rupee terms 355? Can you think of any possible reason why people are ready to pay a premium of 355? Because the share price, currently it is 80, sir. Currently the share price is 80. Suppose if I buy this bond today, what price will I have to pay to buy this bond today? I have to pay 1475. Okay. Is the price of share going to remain constant in future? No. If the price of the share increases, let's say instead of 80, the price of shares became, suppose 150. Suppose market price of share became 150. Then, let's say at the time of maturity, the market price of the share became 150. So at that time, what is the conversion value? It will be, of course, 150 multiplied by 14 shares, which is 2100. Now, if I buy this bond at 1475 and I have to get it converted to equity shares, at the time of redemption, will I be required to pay any premium? No. Because once you buy this bond today, you are automatically entitled to 14 shares. Once you buy the bond today at 1475, can I say you are automatically entitled to 14 shares, whatever be the value of the shares? In future, be whatever the value, you will get 14 shares of the company if you are choosing to get the option of getting it converted to equity shares. So can I say there is always an upside potential, which you always have that upside potential. Today, if I buy this bond for 1475, can I say whatever be the price of the bond, you will be able to get the shares, which is to the count of 14. You will get 14 shares without any additional payment. So there is 100. Whatever be the price of the shares, you will be entitled to 14 such shares. So because of that upside potential, because of the possibility of you getting shares which are having, higher value, can I say 1475, if you buy this bond, you are automatically entitled to 14 shares. So you are locking the price of 14 shares, which is going to happen in future. So if going ahead in future, if let's say conversion value becomes like 2100, if the market price turns out to be 150, so you will redeem these bonds by getting a conversion value or getting shares which are worth 2100. So there is always that upside potential or possibility of higher price of the shares, and therefore you are ready to pay premium for this bond. Are we clear, guys? Why a convertible bond will trade at a premium? Because of the because of the upside potential, right? Whenever you see that there is a potential or a possibility of a income or gain in future, can I say you attach premium to it? You attach premium to it, correct guys? Yes or no? Like even in case of tickets, like just recently you might have heard something called as Coldplay tickets. Are you aware? Coldplay concert tickets, right? So I think that was of some sort of legality issues or some sort of problem is going on with Book My Show CEO. But the idea is not only that person, but everyone, in the young group like you, like me, who are fan of the Coldplay band. So they always have that thinking that if I buy this ticket, I will obviously have a chance of getting a customer who will be ready to pay a premium for this. So even if the base price of the ticket is, let's say, 1,000, still people were ready to buy it for 5,000 or 10,000, because they always assume that okay, I can sell it for 15 or 20,000. So whenever there is an upside potential possible, you always pay a premium for it, right? Be it a financial product or be it any other aspect also. Whenever you observe there is an upside potential, you are ready to pay a premium for it, right? So that's where we say that the investors are ready to pay a premium here, because they would be obviously foreseeing the price of the shares to be increasing beyond the current level, and that is getting compensated in the way of additional premium that we pay. Okay, so that discussion was not required in the question, but just I thought let me clarify, because some of you may get a question as why people are ready to pay premium for this convertible bond. Okay, fine. Now let us do one thing. Let's do this question 22. Let's do this question 22, guys. Yeah. Saradam Limited has issued convertible debentures with a coupon rate of 12%. Each debenture has an option to convert to 20 equity shares at any time until the date of maturity. Debentures will be redeemed at ₹100 on maturity of 5 years. So debentures are going to be redeemed at 100. An investor generally requires a return of 8% on a 5-year security. As an investor, will you exercise the conversion for given market price? So market price of maybe 4 rupees, 5 rupees or 6 rupees, cumulative PV factor is given to us. So are we going to exercise the option to convert these shares? Okay. Now, if the debentures are not getting converted, so if debentures are not converted, then what will be the value of the debenture? We can arrive it on the same line as here: cash flows, PV factor, and the PV. So it's like year 1 to 5, because 5 years was the time, right? Yeah. So on this, you're going to get a coupon of 12%. So cash flow is 12. PV factor is also given to us, which is 3.993. So PV will be 12 into PV factor. And then in the 5th year, we are going to have a redemption of 100. 5th year, redemption of 100 with a PV factor of 0.681. This will be cash flow multiplied by PV factor. And then you take a summation, which is 116.016. Right. So this is the value of the bond that we have. Right. This is the value of the bond. Current value of the bond is 116, 5 or 6. So market price per share, they have given 4, 5 or 6. That's the range given to us. and number of shares are like, how many shares are we going to get? 20 equity shares for each bond. So it is 20. So what will be the conversion value? Conversion value. Conversion value will be like 4 multiplied by 20. So if the market price is 40, then 20 shares will get converted to in total 80 rupees. Then market price is 5, so 20 shares will get converted to 100, and 6 shares will get, if market price is 6, then the shares will get converted at a price of 120. Current price is 116.016. So when will you like to get it converted to equity shares? If the price is 40, this debentures will get converted to equity shares, and value of those equity shares is like 80. Of course, will I get it converted when the value that I'm going to receive is 80? Will I get the debenture converted when the market price is 40? Market price is 4 and the conversion value is 80? Of course, no. At market price of 5, no. But can we get it converted at a market price of 6? Yes. Right? Because you pay 116, but you get it immediately converted so that you get shares which are worth 120. So there's a straightforward 4 rupees gain. Right? So we can say bond will be converted to equity share when market price per share is 6 and above. So whenever it is 6 and above, you start getting the benefit of conversion. Okay. Very good, guys. Fine. So let's just do one more question, question 23, before we take a break. I'm just taking this question 23 because it's not connected to this conversion aspect. So let's just complete this conversion factor fully, and then we can take a break and then come back with discussion on some other aspect. So let's do this question 23, guys. So data given below relates to a convertible bond. Face value is 250. So this is assignment question number 23. So face value is 250. Face value is 250. Coupon rate is given to us as 12%. Coupon rate is 12%. Number of shares per bond, or I can say conversion ratio, is basically 20 for each bond. Each bond is going to get converted to 20 shares. Market price of share is 12. Market price of share is 12. Straight value of the bond. Straight value of the bond is 235. Right, straight value of the bond is 235. Market price of convertible bond. Market price of so if it's a convertible bond, then the market price stands as 265. So when we say straight value of a bond, what do we mean by this straight value? Value of bond without conversion option. So straight value is basically 235, which is value of bond without any conversion option. So straight value of the bond is simply value of the bond where you don't have any conversion option. Okay. So straight value is the bond without any conversion, like a normal bond. Now, of course, since our bond is convertible, the current market price is 265. First one is stock value or conversion value. Stock value or conversion value. So stock value or conversion value. Can you tell me how do we get the stock value or the conversion value? stock value or the conversion value. So it's like each of the share is having price of 12 and there are 20 shares which will be getting converted. So conversion value is basically 20 multiplied by 12, which is 240. Right? So if I get a share converted today, if I get the debenture converted today, I get a shares which is worth 240. Then second part is percentage of downside risk. Percentage of downside risk. See, market price of the convertible bond is 265. Okay, which is obviously at a premium as compared to the straight value, which is obviously premium of a straight value, which is 235. Now, if the stock is worth less, like the share price that we see 12, if it becomes zero, will the bond have any value or no? Will the bond have any value or no? If let's say the market price of the share becomes zero, will the bond have any value? Market price of share is zero. It means conversion value will also become zero, right? Is the bond going to have any amount of value? Yes, because it is a convertible. When we say convertible, you have a choice to get it converted only if it is beneficial to you. Okay, but if you don't want to convert, can I say you are still going to get the face value of the bond? If you don't want to convert, you're still going to get the face value of the bond. So considering that you're not going to convert, what will be the value of the bond? Value of bond, if conversion option is lapsed, 35, or I can say this will be the value of bond if market price of share becomes zero. If the market price of the share becomes zero, so are you going to get it converted to equity shares? Suppose if the market price of the share on the maturity it becomes zero, are you going to get it converted to equity shares? No. What will you ask the company for? What will you ask the company for? You'll ask the company to pay the cash value. Now, obviously, the present value of that cash value is 235. So, value of the bond if market price is zero is zero, that is 235. And what is the current market value of the bond? Current market value of the bond is 265. So, what sort of downside risk that you have? The bond value, it can go down up to what value is? Up to what value the bond value can go down? The bond value can fall from 265 maximum to 235, right? So percentage of downside risk is simply 265 minus 235 upon 265. So this becomes 30 divided by 265, which is 11.32%. That is the percentage of downside risk. Simple. That's the percentage of downside risk. So bond is not expected to fall below 11.32%. Okay. Then the next thing is, what is a conversion premium? We know what is the conversion premium calculation now. We have done it in the previous question. Conversion premium is basically 265 being the current price minus the share value is basically 240. Share value is basically 240 divided by the conversion value, which is 240. Right. So this is what we have already covered in the previous question. So conversion premium in percentage terms, it will be 25 divided by 240, which is 10.41 or 42%. Right. Then we have the conversion parity price. What is conversion parity price? conversion parity price of share. We are talking of conversion parity price, but this parity price is applicable to the share. Currently, the bond is valued at 265, and this bond is entitling you to 20 shares. So, what should be the parity price of the share? It will be 265 divided by 20. So, considering the current value of the bond to be 265, the shares seem to be valued at 13.25. But if you look at market price of share, it is currently 12. So, what is the premium that is attached? Can I say there is a premium of 1.25 per share which people are ready to pay right now because they expect some future upside potential. They're expecting some future upside potential and therefore they're ready to pay this premium. Okay. Conversion parity price of the share is basically the price that should be prevailing for the equity shares if the current market price of bond is considered. Okay, so this is like the conversion premium, you can say, which is 1.25 per share. We can also got this 25 over here. So 25 divided by 20, that also gives you the same 1.25 value. Are we clear, guys? MPS is market price of share, Abrakesh. MPS is market price of the share. Okay. So conversion parity price of the share. Okay, you were saying MPS is equal to bond price. That's a situation which is the conversion parity price. Okay, absolutely right. Okay, guys. So we have done the questions based on the conversion part. Now, let's just take a short break of 10 minutes. Post that, we'll come back and discuss about some new concepts in this bond market. Yep. So let's take a short break, guys.
अशोक जी, मैंने एक मैसेज भेजा है, देख लीजिए ना। मैंने एक मैसेज भेजा है आपको, ये मैसेज बॉक्स में, चैट बॉक्स में, देख लीजिए ना आपके नाम पे। और शुड आई टेल यू?
सर बताइए सर, प्लीज अब्रकेश सर। कोई इशू नहीं
इसमें जो देयर इज नथिंग सीरियस, मतलब मीटिंग चैट में एलबीसी फाइनल फॉर May 24 दिखा रहा है।
हाँ, तो आई थिंक अशोक जी वो पहले का ही आ रहा है ना शायद वो। सर वो ऐसा है, ये मीटिंग आईडी है ना सर, ये
अच्छा, ओके।
ये
conversion parity formula. Conversion parity formula is bond value divided by number of shares. So this is essentially equal to bond value upon number of shares. Okay, now let's take up a concept now, which is something called as Macaulay duration and modified duration. Jeannie Oja is saying you would not feel that what the time of 2 hours on. Enjoy very much. Thank you. You're welcome, Jeannie. So we are looking at something called as Macaulay duration and modified duration. Let's understand this concept today. What's this Macaulay duration and the modified duration? We know what is duration, which is a time period, but here this term Macaulay and modified is actually denoting something different. Okay, so this is something different. Let me first look at this Macaulay duration, and then we will take it forward with modified duration. So first, let's try to compute the Macaulay duration. So to simply understand what is Macaulay duration, Macaulay duration is representing the number of years which is required to recover the cost of the bond, right? Or we can also say Macaulay duration is the weighted average of time period of investment in a bond. Okay, so Macaulay duration is basically weighted average of time period of investment in a bond. So for that, let's take help of this particular question. We're having this one. We'll take help of this question to understand what is a Macaulay duration. We'll do it in a bit differently. Okay, so suppose we have a face value of a bond to be 100, coupon is 10%, redemption is 110, maturity is, let's say, let me take it is easier, 3 years. And let me just change it to maybe coupon of suppose it to be 6%. Okay, so let me calculate the value of this bond using the normal method. Just like here, 1, 2, 3. We'll have it for more number of years. So we'll have it for 3, 4, 5. So I'm purposely writing it in this way so that we'll be able to calculate something that's required. Cash flows from this bond is going to be like 6 rupees in first year, and that goes on till 4th year, and finally in the 5th year you have 110 as the redemption value. Then present value factor at a YTM of 5%. Okay, so present value factor at a YTM of 5%. We can say it is 6, or I can calculate this as 1 divided by 1.05 to the power of number of years. And then I get the, of course, in the 5th year, the cash flow will be 116, right? So these are the PV factors that we use, and then we arrive at the present value. And then we take the sum of it. This is how we arrive at the value of the bond. So what is the amount that we are going to pay today to get this bond? What is the amount that I have to pay today to get this bond? Yeah. What will be the price? What is the amount that I need to pay to buy this bond? $112.16, right? Now the amount that you are investing, this 112.16 in present value terms, in current value terms, the amount that you are investing 112.16, is it going to stay invested in the bond for entire duration of 5 years? This 112.16, the amount that you are putting into this bond, the money that you're paying to get this bond, is it 112.16 invested in the bond for the full period of 5 years? Is it going to stay invested in the bond for a full period of 5 years? No. Can I say some portion of the bond is getting recovered by us during the years? Some portion of the value of the bond is going to be recovered by us during the years. Am I right? Right. So out of 112.16, can I say in present value terms, 5.71 will be recovered in 1 year? Am I right? Out of this 112.16, 5.71 will be recovered in 1 year. Can you tell me, by the end of third year, what will be the value of the bond that we would have recovered from? At the end of third year, what will be the value of the bond that we would have recovered? By the third year, what will be the value of the bond that we would have recovered? Can I say it's a total of these three, which is 16.33, right? So that's what we say, that the value that you're paying 612, it's not going to be blocked in the bond for the total period of 6 years. You are going to get it recovered part by part. Right? You're going to get it recovered year on year in some proportion. So this present value is basically used to recover the value of the bond part by part. So that gets recovered year on year, some portion. So if I ask you, what is the weightage? What is the weightage of the bonds? What is the weightage of your investment that is getting recovered in 1 year? What is the weightage of the bond that is getting recovered in 1 year? Can you tell me what will be the weightage that is getting recovered in 1 year? What is the weightage that we are getting recovered in 1 year? Can I say 5.71 out of 112.16? Can I say 0.051? Or I can say, if I talk in percentage terms, sir, 5.09% of the bond, 5.09% of the bond is getting recovered in 1 year. Correct, guys? Then what weightage is getting recovered in 2 years? It is 5.44 divided by 112.16. So that's like 4.85% is getting recovered in 2 years. Same way, I can get the weightage which is getting recovered in each of the years by simply calculating the weightage over here. We all agree that a major portion of the bond value is getting recovered in the 5th year, which is 81.03. A major portion of the bond is getting recovered in the 5th year, which is 81.03%. But during the intermediate term, we are also recovering some value of the bond. Some weightage is getting recovered. So now, as the Macaulay duration is there, which is weighted average of the time period of investment in bond. So we want the weighted average of time. this is basically the time that we have, and this is the weightage. Now, how do we calculate the weighted average time? Weighted average time period of investment. Weighted average time period of investment. Can I say it will be just summation of weights? Summation of weights into T. Upon summation of the weights. Am I right, guys? I hope you are aware of the weighted average formula. You all are aware? Weighted average formula, everyone? You all know this formula, right? Summation of weights into X upon summation of weights. We have a formula like this, na? The summation of weights into X upon summation of weights. Yes, we are all aware, right? So that is summation of weights into T upon summation of weights. So we know summation of weights into T is 112 point. Sorry, we have not yet calculated my bad. So I need to get the weights multiplied by the time. Now this is weights multiplied by the time. So this is weights multiplied by the time period. So weights multiplied by the time. We just take a sum or total of this, right? And we know it is summation of all the weightage is simply going to be 1 or 100%, or we call it as unit. So this is going to be 4.514 divided by, of course, 100%. So that's going to be the 4.514. 4.51. Right? So this 4.51 is the number of years, or this is the average, weighted average number of years for which the investment is there in the bond. Are we clear with this concept, guys? 4.51 years, the weighted average time period. Are we clear how to calculate this weighted average time period of investment? Yes, everyone? Are we clear? Weights into time. Yeah. So weighted average time period of investment is simply what we call as the Macaulay duration. Now, the significance of this weighted average time period, which is the Macaulay duration, is very less. It's not that great. Okay, it's not that very great significance or usage of it. But yes, using Macaulay duration, we are going to calculate something that's really going to be interesting for us. Using weighted average time period, we're going to calculate something that's is going to be interesting for us, or that's going to be very useful for us. Weighted average time period, we generally say it as a Macaulay duration, that will be used in some concept called as bond immunization. We'll take up in the subsequent sessions what is bond immunization and all. But yes, Macaulay duration is simply the weighted average time period for which the money is blocked in the business. Okay. So weighted average time period for which the money is blocked in the business, that's the Macaulay duration. Now, this Macaulay duration we'll be using to calculate something called as modified duration. We'll be using this Macaulay duration to calculate a point called as modified duration. Now, what is modified duration? Modified duration. Okay. See, modified duration is basically something similar to that of leverages, or something to similar to that of elasticity of demand. Do you remember leverages? Do you remember leverages from CA Inter? Do you remember leverages, guys? Yes? Okay. Remember the leverages to be from CA Inter. Leverages was basically percentage change in, you know, some EBIT due to percentage change in the sales, or percentage change in what we say, percentage change in EPS due to some percentage change in EBIT, right? Something of that sort. So modified duration is basically expected percentage change in bond value, expected percentage change in bond value due to 1% change in YTM. So modified duration is basically what is the percentage change that you are expecting in the bond value due to 1% change in the YTM. So we can simply say that modified duration is simply the percentage change in bond value that we are expecting due to 1% change in YTM. Now tell me, as the YTM changes, will the bond value change? As the YTM changes, will the bond value change? Yes? Okay. So expected percentage change in bond value due to 1% change in YTM. We can say there's an inverse relation. So of course, as the YTM changes, bond value is also supposed to change. As the YTM changes, bond value is also going to be changing. So that's okay. Now, how do we calculate this modified duration, this number? This is going to be calculated as Macaulay duration upon 1 plus YTM. This is Macaulay duration upon 1 plus YTM. So Macaulay duration was 4.51. And then we divide it by 1 plus YTM. So 1 plus YTM means it will be, of course, 1.05. Because YTM was 5%, right? When we were discussing this, YTM was 5%. So this works out to be what number, guys? 4.51 divided by 1.05, which is 4.30. Which is 4.30. Right? So 4.30. How are we going to measure this? If I'm saying that it is the expected percentage change in bond value due to 1% change in YTM. So what is this 4.30? This 4.30 is actually measured in times. Right? So for 1% change, how many times is going to be the change in the bond value? That is our modified duration. Right? So how do we interpret this 4.30? We interpret this 4.30 as for 1% change in YTM, there will be 4.30% change in bond value. So when I say it is 4.30 times, it is like for 1% change in the YTM, there will be 4.30% change in the bond value. Right? So just like leverage, right? Just like leverage, that 1%, if there is a change in sales, what will be the percentage change in the EBIT or in the EPS? The same way over here, 4.3 is indicating that if you are changing your YTM by 1%, the bond value is going to change by 4.3%. Okay. Now, let's try to prove it. Let's try to prove it here, guys. We have the YTM and the price. So when we had a YTM of 5%, we had a YTM of 5%. The price was 112.16. Now let's do one thing. Let's increase the YTM by 1% to 60%. Let's increase the YTM by 1% to 6%. Okay. So from 5% to 6%, we are obviously looking at 1% change in the YTM. Can you give me the value of the bond at a YTM of 6%? Using these same parameters, can we obtain the value of the bond using 6% as the rate at a YTM of 6%? Can you give me the price? Can you calculate the price, guys? Yes. Can you calculate the price and give me the price at 6%, guys? Suppose if the YTM is turning out to be, let's say, 6%. What will be the price for a YTM of 6%? Please give me the price, guys. You can give it to me, right? Can you calculate? At 6% YTM, can you calculate the price of the bond? Don't do that cross multiplication, guys, please. Cross multiplication doesn't work every time. You need to calculate the value of this. Like take the years, then cash flows, PV factor, and PV. Okay. You cannot cross multiply it. It challenges the basic assumption that as the YTM increases, the bond value should fall. Right. So do this and give me the price of the bond. So this leaking PV factor, set the rate of 6%. Yeah, calculate the price of the bond. So we'll have like year 1, 2, 3, and then in the third year. Is it okay? So this is like 5 years. My bad, 5 years. 5 years. So maturity is, let's say, suppose 5 years, because we're calculating the modified duration. Yeah, so for 5 years, cash flows is going to be, every time it is going to be 6, and in the 5th year it will be 110. Take the PV factor at 6%. So present value annuity factor at 6%. One divided by 1.06 to the power of 5. Okay. So we get the PV as cash flow multiplied by PV factor, and then taking a total of the present value gives us a bond value of 107. 107.47. Okay, so this is 107.47. Okay, now what is the change in price that we are observing? What is the change in price? What is the change in price that we are observing? Is there a change in price? Yes, sir. New price minus old price. Obviously, as we have said, the price change is going to be negative. So it's minus 4.69, the change in price. This minus 4.69, if I ask you to get it converted in percentage terms, how much is the percentage change in the bond price? Can I say minus 4.69 divided by original number? It is coming out to be 4.18%, right? right guys? 4.69 rupees is simply 4.18%, right guys? So the change that we observe in the value of the bond, as per the modified duration, we got this as 4.30 times. So we stated that if there is a 1% change in the bond value should change by roughly 4.3%. And what we observe over here is it is changing by 4.18%, approximately matching the same trend, which is 4.3. But still there is some difference in it. Still there is some sort of difference in the percentages, right? But yes, overall basis, we can say what is the impact of increase in the YTM on the bond value is given over here, 4.18%. So that's 4.69 rupees or 4.18% wise. There is some sort of difference because we expected, like, if it is 4.30, this should be 4.30. So is it really very far from our expected percentage change? Is it really very far from our expected percentage change? Tell me, guys. 4.30 is basically what we expected. It's 4.19. So it's not very far from our expected percentage change. Let me make it even more interesting. Like, we got the YTM, let's say at 6% we got the bond value, right? 110, we have to consider 110 cash flow only in the 5th year, because 5th year cash flow is considered over here, Karthik. Okay, so 5th year cash flow is already counted over here, so I'm not taking 116 over here. Okay, so now if with modified duration of 4.30, we say that for 1% change in YTM, there will be 4.30% change in bond value. Now, similarly, if I ask you for, let's say, 0.1% change in YTM, there will be how much percentage change in the bond value? When we said that modified duration of 4.3, we expect that the bond value to change by 4.30% for 1% change in YTM. Now, if I'm changing the YTM by 0.1%, if I'm changing the YTM by just 0.1%, how much percentage change are we observing? Or how much percentage change would we be expecting? What percentage change would we be expecting? For 0.1%, can I say there will be 0.1% multiplied by 4.3, that is, can I say 0.43% change in bond value? Am I right, guys? So if for 1% you are saying that bond value will change by 4.3%, so 0.1% if my YTM is changing, suppose my YTM is changing 0.1%, so rate of interest, let's say overall, it increased by 0.1%, I will expect the bond value to change by 0.43%. Okay, so let us try to evaluate it. Like, I'll do the same thing over here. So let's say YTM of 5%, we had a price of 112.16. Now, when I'm making the YTM as, let's say, 5.1%. Okay, so I'm changing the YTM by 0.1%. So I'm changing the YTM by 0.1%. I want to know what is the resultant impact on the price. So can you give me the price of the bond at 5.1%? Can you give me the price of the bond at 5.1%? At a YTM of 5.1%. Can we calculate it? Yes. Now suppose it's same thing. I'm saying that let's try to calculate it for 5.1%. So if it is to be calculated for 5.1%, I'll have to take the present value at 5.1%. Just calculate the present value. Please check if the present value annuity factor is 4.3175 at 5.1%, guys. Is it 4.3175? Please verify. Please verify the annuity factor. Is it 4.3175? And also the PV factor. Is it 0.7798? And value of the bond is 111.68. Perfect. We all got it. So at 5.1%, we have 111.68. So what is the change in the price that we are observing, guys? What is the change in the price? What is the change in the price that we are observing? So it's minus 0.48. Now, if I want you to convert it in percentage terms, how much is it? Minus 0.43%, right? Minus 0.43%. Correct, guys? Now, do you feel that this statement which we made and the resulting value that we are getting here, are they matching? We stated that if there is a 0.1% change in YTM, there will be 0.43% change in bond value. Are we observing that percentage change? Yes or no, guys? Are we observing that percentage change? Yeah. So if I want to summarize it, like percentage change in YTM, we consider the percentage change to be 1%, and we also consider the percentage change to be 0.1%. We considered both the cases, 1% as well as 0.1%. But what I'm really looking for is percentage change in YTM. It's 1% and 0.1%. What was the expected percentage change in bond value using modified duration? What were we expecting in percentage change? Expected percentage change in bond value using modified duration. We expected, like, for 1%, what was the percentage change that we were expecting? Can I say 4.30%? Am I right, guys? We were expecting earlier 4.30%, right? With the original thing, 4.30. We were expecting that for 1% change in YTM, there will be 4.3% change. So when the change in YTM was expected to be 1%, the bond value was supposed to be changing by 4.3%. And for 0.1%, we were expecting it to change by 0.43%. And what was the actual percentage change in bond value that we observed? What was the actual percentage change that we observed in the bond value for 1% change in the bond value? For the 1% change in YTM? Can I say it was 4.18? Right, so this is 4.18%. And here it is coming out to be exactly 0.43%. So do we see any error? Do we see any error? When we were changing the YTM by 1% from 5 to 6, we expected the bond value to change by 4.30%. But the actual change in bond value happened to be 4.18%. So there, we were actually having an error in our estimation, expected minus actual. So we had an error of 0.12%. Whereas in this case, we are having no error. when we were looking for percentage change in YTM of 1%, we changed the YTM from originally from 5% to 6%, and we got the price to be 107.47, and there we translated it in percentage terms. It comes out to be 4.18. And then we tested with 0.1%. 0.1%. So in case of 0.1%, we get the error to be 0. Right? Now, why is it so? You can obviously do the conclusion that as the percentage change in YTM is more, error is going to be more. Right? Now, why is that error going to be more? That discussion, I'll keep it a suspense for the time being. Okay? I'll unveil that suspense in our next session. Okay? But the suspense is, sir, if we are looking for a higher percentage change in the YTM, there is some error that we are observing, because as per the modified duration, the expected percentage change is not getting materialized. Right? But when we're looking for a smaller change, where there is a 0.1% change, we find that there is not much error in our estimation. And that particular fact is going to be unveiled in the next session, guys. So stay tuned for the next session. Now it's time for your queries for the discussion that we had in our today's class.
Any student can ask any query. They are free because we have opened the session.
Sir,
Yeah.
actually, when we calculate present value using half-yearly method,
Present value using?
half-yearly method,
Okay.
we use the PV rate as half. Like if the
Yeah.
present value rate is 6, we use 3%. And the
Correct.
cash flow is, if suppose it's 7, we use 3.5.
Correct.
But the redemption value is taken as 108 and the present value factor is taken as half. Why is it so?
108 will be the full value of the redemption that we have.
Yeah, that's what I said.
Correct. Yeah. And since the rate has been given to you, let me just come to that question. Half yearly thing. Yeah, this one.
Yes.
Right. So half yearly, it is this 10,000 is going to happen in the fourth half year. So the rate that has been given to us, the YTM of 6% per annum, this is a nominal 6% per annum.
Yes.
Right. And I'm getting it converted to 3% on a per half year basis. So this 10,000 is going to happen after 4 half years from now. And therefore, we take the present value using the 3% for 4 half years.
Okay.
Okay.
Okay. Okay.
Okay.
So, and one more question I had.
Yeah.
Do you have your draft from the previous classes? Or the previous class actually?
Previous?
Last class.
Draft.
Yeah.
It's not draft as such, but whatever I do is on the screen. What we do is discussed on the screen that we have. So I'm not getting what sort of draft you are talking of.
Sir, the solutions that we solved, because in the previous class, right before you went to the break, you solved the question, which was not there in the recorded session, and I wasn't present in the previous class, so I wanted to know if you had the question.
Which question?
The question just before 3-step model.
Tell me the number, no, question
I
number
don't
then.
know, but after question number 4 and before 3-step model. Just before 3-stage model. Yes, sir, just before this.
So this is 3-stage cash flow, and then this was. I don't think there is any question that we have done. This one?
After question number 4, did you solve any question?
After question number?
4.
So is this the question number 4? 030.
Yes, sir, this is the question number 4. Okay, sir.
No, not so. Because we simply started with a 3-stage.
Okay, sir. Thank
Yeah.
you, sir.
So can you take recent MTP MCQs? There are 14 and 15 new MCQs. They are completely new. I haven't seen somewhere.
Okay. Now you are talking about MTP.
Yeah, recent MTP.
Okay. Dear student, please note that there will be I think in a week or so, there will be a BUS for the success session. Okay, there I will take the MTP discussion.
Okay, sir.
Okay, so I will solve each and every MCQ there
Okay.
because it is not related to exactly bond classes. Okay, because it is,
But
I will take up this session, and in this session I
that's
will
related
solve
to
all the.
yield. That's related to yield curve only, na, sir?
Huh? No problem.
That
I will take every MCQ. Don't worry.
okay, sir.
Okay. Okay. You are asking about the yield curve.
Yeah.
Okay. Don't worry, student. If possible, right now I don't have the in this moment. I have not the exact solution with me. Of course, so in the next class, if possible, I will take there. Otherwise, just wait for another. I think 1 week. We are starting with coming out with the BS
So
first.
actually, the same thing is not found in module. I have been searching the exact same pattern of things in module, but I didn't
See,
find
beta,
it.
in a module, if you see that there is a concept of forward rate.
Yeah,
Okay.
calculations are there.
Calculation. So based on that calculation, if you solve the question, you will get the answer.
No, I got the answer. I just want to see the logic, exact logic of it.
See, there is beta exactly if you go by the logic, because we are assuming, say if I want to know the rate 2:5, okay, forward rate for the 2:5. Say after 2 years, if I want to invest the money for the 3 years,
Yeah.
we can say that. So we are just estimating on the base of yield curve. It may be possible that after the 2 year, or the 3 year, there may be a different rate. Okay, so logic is not that only logic. If we see that, it is basically based on the concept of compounding. If we are using the compounding method, if the rate of interest is same, so by same rate of interest we are compounding. But when we have a different rate for different year, so we have to use different rate for different compounding year. Are you getting it? Say if I say that if you have if you want to compound the rate of interest at a 10% for 2 years, okay, so your value will become 1.21. Okay, because you are making 1 plus 0.10 raised to power 2. So this
Yeah.
factor come 1.21. Okay, but if I said 1 year rate is 10% and next year rate will be 9%. So of course, then this method that is making the square will not work. You have to carry out 1 plus 0.10 plus 1.09, then you will get the answer.
So, but exactly the question is that 3 year purchase, right? The rates are different for each year. Like for 2 year, if I am investing, the rate is 6%. For 3 year, I am investing, the rate is 7%, which means every year there is 7% increase.
No, not every year. It says that if you want to invest the money for 3 years, you will get the return of 7%. Okay, if you want to invest the money for 6 years, 2 years, you will get the interest of 2 years, and that is the property of yield curve. Longer the period, higher will be the interest rate. Okay, but if you say if you want to invest after 2 years for 1 year, then this rate will be separate.
Okay.
Okay, this rate. So accordingly, you have to do. Are you getting my point or not?
So we will take question in next session, so it will bring more clarity.
Okay. If possible, I will. Okay, I will try. I will in the end. I will solve the question. Okay.
Okay, so thank you.
Okay. Any other query? Okay, student. With this, we come to the end of this session. And in today's class, sir has started with the bond valuation, that is part of fixed income valuation, fixed income securities valuation. Generally, it is called as a bond valuation, but the correct word is fixed income valuation, because generally it can also be the debenture also. And today we shall continue this session in the next class. Student, till today's class, whatever has been covered, please revise the same. Thank you, Jagbandhu sir, for sparing your precious time and enlightening the student on the same topic. And thank you, students, for your patient listening. See you in the next class. Thank you. Have a nice day.
Thank you, sir.
Yes, over.
Thank you.
Thank you.
Okay.